Hello and welcome to our first edition of Market Makers 2014, and let me kickstart this show with one of the smartest stock pickers on the street, Ravi Dharamshi, Chief Investment Officer of ValueQuest. Ravi, thank you for joining us. Ravi, the year has changed, but the trend also has changed. The excitement from 2013 has not rolled over to 2014. We're off to a rusty start, not only locally but globally as well.
From our perspective, I believe these are exciting times. Finally, we are stock pickers. Yes, the macro trends are not yet very clear, but if you look at what are the ingredients that you need to have a bull market, it would be an apathy towards stock market, under ownership, liquidity, cheap valuations, and improving fundamentals. I won't say all the things are in place. Maybe the fundamentals are still not improving to that extent. And domestic liquidity is still not very abundant, but international liquidity is there, and there are pockets in the market where the fundamentals are improving. So we are quite excited. There are good stories out there, and the valuations are reasonable.
So let's go through all the points one by one, which you've just outlined are the core ingredients for any bull market. Valuations. Sensex is trading at about 14-15 times. Companies where visibility is strong, which is IT and pharma, they're already expensive. So what is so attractive about this market? Because what is growing is already expensive.
The 14-15 times multiple by itself is not an expensive number. Historically, we have traded above 15. Where the valuations that you say are expensive. Now let's take an example of technology. HCL Tech came out with good results today, or Infosys came out with good results a couple of days back. They are quoting at a multiple of close to 15 times, 16 times FY15. And for a company that is growing between 14 and 17% and having margins upwards of 25% and ROCE of greater than 40%, I don't see any reason why they should continue to quote at these valuations.
So on top of a good 2012 and a great 2013, you think IT stocks or large cap IT stocks can still give double-digit returns on a CAGR basis?
Absolutely. There is still a lot of juice left. People are underestimating the kind of growth that can come in. I'm not talking that they'll grow more than 25% CAGR, but improvement to 18 to 20% CAGR can see multiple improving dramatically for them.
So as a house, you still believe that don't sell IT, in fact add more IT on every decline?
We believe, yes. We are not adding any more at this point of time. We have had sufficient allocation some time back. But yes, we are not at all bothered about any dips, and from a 2-3 year point of view, we are going to stay invested.
The two bugbears for 2014 are number one QE and the second is GE, which is quantitative easing and general elections. We don't know which way US Fed would move, and we don't know the outcome of elections. So what makes you confident that this year will be a good year for equities when the unknown factors are also, big?
So let me start with quantitative easing. I don't believe that the tapering that US Fed has started is going to result in big liquidity being sucked out of the world markets. If you remember what happened in early 2000, at the beginning of this century, Alan Greenspan had kept the rates quite low for an extended period of time, and that led to a fantastic bull market. This time around, there is confluence of factors. Not only US, even Japan and Europe are making sure that they do everything to ensure nothing goes wrong. Essentially what that means is they are going to make sure that there is enough abundant liquidity out there. If the US has attempted to reduce a little bit of the liquidity, that means the fundamentals are improving. Their confidence in the improving fundamentals is, I would look at it as positive, and that's how markets have taken a view as well. On the other hand, India receives a drop in the ocean in terms of global liquidity, and India is not going to get funds just because there is global liquidity. We have to have improving fundamentals to attract that liquidity. If you see, the liquidity has been very discerning. FIIs have bought into only those stocks or sectors where the fundamentals are improving. There is a genuine improvement in technology, pharma, agri, select auto, where the liquidity has flown in. So it's not euphoric, it is not blind buy. Buyers are very aware. There is everybody is trading cautiously, yet it is very clear that it is time to buy.
So you think big money will be made this year and next year?
Sure. The returns will definitely be positive. Quantum we can debate depending on how the various variables play out. We have had 5 years of almost no returns, and on the other asset classes, real estate or gold or even fixed income doesn't look that attractive. Fixed income, I mean, inflation is eating into it. I don't think it's generating positive returns. So equity is best positioned amongst the asset classes, and yes, it will generate better returns going forward. I can't say for sure in this calendar year, but on a 2-3 year basis, the CAGR returns will be upwards of 15%.
Tell me about your top 3 holdings.
Okay. So the way we are looking at this market is, as I told you, there are pockets where the fundamentals are improving. We like IT, we like pharma, we like agri, we like select auto components. We still are not gung-ho and going out and buying a company which is saddled with debt or is having balance sheet issues. We are still trying to focus on where companies where there is balance sheet is under control. There is an improving growth scenario or an improving margin scenario because the costs have come under control, or they are addressing a new market or possibly launching a new product. So the sector-wise, these are the things we are focusing on, and within that we would like to focus on a company that is gaining market share or is addressing new markets.
So you like Amar Raja. That has been that is one stock which has worked for you. What's the thinking behind owning Amar Raja? Are you happy to own Amar Raja even though it is 2x for you or 3x?
It is 3x plus, I would say. And yes, we continue to hold and own Amar Raja. We believe, we have been strongly believing since last maybe 10-12 quarters that Exide has lost the plot. But it is only now that the street is also veering towards that view. Amar Raja has its strategy right in place. They have nice, they are gaining market share in replacement. They are strong in industrials and telecom, and it is right now the auto OEM that is suffering and the inverter market that is suffering, which is why Exide is losing out. So and Amar Raja is not a price leader. They always take price increase or decrease with a lag to Exide. So I think they are playing smart. They are letting some gains go by. At the same time, they are making sure they don't lose market share. So I think they have the strategy right. Apart from that, on the product side, they have good backing from Johnson Controls, and their product and its acceptance in the market has really increased. I think their market share would have increased from 20-23% to 35% in auto replacement over the last 2-3 years. So that is a big, that speaks for itself.
You've recently invested in Infosys. What's the thinking behind that call?
So we are very bullish on technology per se, and within that Narayan Murthy is the one that has come in, and he has spelled out the strategy. The strategy is get costs under control, perform or perish attitude. Also, apart from that, Infosys remains one of the most, how would I say it, it's still an inefficient machine as compared to what it was.
Utilization is low.
Utilization is low, margins are low. They're not firing on all cylinders. The valuations are still at 15-16 times forward. If you believe that NRN can turn this giant ship around and perform, I believe there is enough money to be made in this large cap only. I mean, we can have a doubler over a 3-year period.
Do you think Infosys go to 6,000, even 7,000?
Surely, why not?
Are you happy to own it for 3 years?
That's what we intend to do.
The way you invest as a house is that you believe in taking concentrated bets, you believe in buying good stories, and you're happy to sit on your investment for next 2 to 3 years. With that kind of an investment philosophy, tell me, why have you bought into Natco Pharma, which some would argue is a event related story or an event related stock?
So Natco Pharma is an interesting company. They have chosen to focus on oncology. They've chosen to focus on high on chemistry, complex products, low competition products. And as a group, we also like to take concentrated bets. Essentially, that's what Natco is also doing. They are not hedging their bets. They are not trying to be everywhere. They say, we are good at this. We are going to focus on this. Now, about their capabilities, so Copaxone is the one opportunity that is on the horizon. It's a $4 billion drug globally, 3 billion US, 1 billion Europe. And they are one of the only two filers. Apart from Momenta Sandoz. Momenta Sandoz is one player and Mylan Natco is the another. So they have hedged their risk by partnering with a larger guy. Now, what is the downside? Let's say they do not get approval. They'll still, the drug still goes off patent in September 2015. If, on the other case, if they do get an approval and launch in May 2014, the kind of cash flows that they can generate. Let me put it in perspective. So this is, they are going to be 750 crore revenue and roughly about 180-190 crore EBITDA and 100 crores PAT this year.
This is without Copaxone? This
is without Copaxone. And without Copaxone, that 100 crores PAT will go to 125 crores. 2500 crore market cap. So it's quoting at 25 times FY14 and 21-22 times FY15. So there is some amount of Copaxone option value built in, but it is not going to be a life-threatening scenario. The worst-case scenario in Copaxone now is that launch gets delayed by a year, not that they will not be able to launch, and the balance sheet is strong enough to support. They have just done a fundraising and they are preparing for their 2019-20 opportunities. They are building capacities for that. So we are very optimistic on their product selection, on their ability to genericize the opportunity and monetize it. So, and we have entered at a valuation where the Copaxone value was not built in. So we are going to stick with it. We are going to, even if in the next few months the Copaxone does not materialize, we believe the company is still strong and they are going to have further opportunities. If I were to elaborate, they have other small drugs apart from Copaxone, which can provide them with an organic growth. So, but the fear around this is that it is dependent on few products. Surely some amount of truth to that, but my belief is that in pharma, finally the majority of profits come from a product or a market.
Right. Okay, Aurobindo Pharma, another big holding. Now, they don't have the best balance sheet in the industry. B, the stock has seen a vertical run up from about 150 to about 400. Are you still bullish on Aurobindo Pharma? Because Aurobindo Pharma is no longer a cheap stock. It was a cheap stock.
No, it is still a cheap stock, provided the story pans out. So why was it a cheap stock? It was a cheap stock because they had funded their vertical integration with debt. The debt was foreign, so rupee depreciation hurt. We can hope that the worst of the rupee depreciation for the moment is over. They had also underutilized capacities. They were focusing on low margin products, ARVs and APIs. Now the focus is shifting to high margin products. They are curtailing the ARVs, and APIs is also more going for internal consumption. They are moving from, so more of their sales will, I think if I'm not wrong, 45% of their formulation sales will go to about 60, 65 or maybe 70% in 3 years'
time. So they're moving up the value chain.
They are moving up the value chain. The demonstration of which has come in the last 2 quarters. If you see that their margins improved from roughly 15-16% to about 20% plus. They showed a result, margins of about 23.5%, out of which 2.5% was due to rupee depreciation. So they got the benefit of rupee depreciation in their margins. However, a margin of 20% plus is something that markets could not imagine, because their product, they are yet to start their injectable story. So they are close to zero in injectables, and they are proposing to go to $100 million in 3 years' time. and injectable is a far higher margin business.
So they're doing all the right things.
A lot of things went wrong for them. They had that import alert which took 2 years away from them, and at that point of time they had committed to the capex. So now it's time to sweat the assets and let the cash flows flow in.
So all the stocks which we've discussed today, you're happy to own them irrespective of the election outcome?
Surely. So we have tried to focus only on areas or on stocks or sectors where the fundamentals are improving or will improve regardless of whatever the election result. So like we explained, Natco and Aurobindo are definitely not dependent on whatever happens in election, or for that matter Amar Raja is gaining market share. It is at the expense of Exide at this point of time.
So these are independent stories?
Yes, there are enough independent stories out there.
When I learned that you bought into TVS, my first reaction was, why TVS? Number 4 player in the two-wheeler market, lowest market share, lowest margins in the industry. Yes, market capitalization is not all that high, but what will really reward a minority shareholder? Hero and Bajaj Auto, they've got much larger market share and their margins are superior.
You know, when I first started looking at TVS, I had exactly those kind of doubts about it.
So I'm not wrong?
No, absolutely not. That is how you would start. But then at the other hand, what were you getting? You were getting a sound engineering company with a presence in two-wheeler market, which is, I believe, has not yet stagnated, still growing, and they have just recently tied up with BMW. And the new management is looking to re-energize the product portfolio. So I was getting at sub 2,000 crore market cap a company with a possibility to succeed and a 400 crore cash flow. So they had issues. Their Indonesian subsidiary was bleeding. Losses are reducing, not yet completely gone away. There is a trend. In fact, there is a scooterization of the two-wheeler industry. There is a wave towards scooters, and coincidentally or maybe by strategy, TVS Motors is best positioned to take advantage of that. So apart from Honda, that is reaping benefits of Activa, TVS will take the most benefit of it. Now, to give you an example, you wouldn't believe Eicher Motors was earning about 35 crores of profit from Royal Enfield. In, I think, 5 or 6 years' time, their profit just from Royal Enfield is going to be 750 crores. So what this company needs... 3,000
Royal Enfields a year, now they're selling 3,000 Royal Enfields a month. So, okay,
so what they need is one product. One product which they can sell 50,000, 60,000 instead of the 10, 15, 20,000 that they are...
about the investment thesis, let me ask you a direct one. So the current market capitalization of TVS is about 3,500 crore.
Correct.
Do you think in next 3 years, it deserves to have a market cap of 20,000 crore?
That will depend on them getting a lot of things right. So if BMW and their tie-up does produce a good product, and if they are able to maximize this scooterization trend, if they can have a product which is selling 50,000, 60,000 in the next 3 years' time, then I don't see a reason why it cannot.
In terms of a general avoid list, what is on your avoid list? Because the art of making money is important, but the art of not losing money is also very, very important.
So at this juncture, we are avoiding any business that is very capital intensive or is dependent on capex cycle reviving. We are not very enthusiastic about that.
So you're not going close to L&T, BHEL, Crompton, Thermax. You think that's all hope and hype that we have a new growth cycle in place?
Yes, I feel the fundamentals over there will take much longer to improve. So I will not comment on a particular stock, but in general in that space I don't think the problems are over and done with.
The outlook on banks is split right in the middle. The bulls would say growth will come back, NPAs will reduce, repair work will start. The bears would insist that banks have a huge problem, rates will not come down because inflation in India is structural. Which way are you leaning?
We are leaning more towards giving a benefit of doubt to the private sector banks. We are not very keen on PSU, even though, I mean, they might be good trading bets. They might be good trading bets, but the public sector has an inherent problem. Every 3 years or 5 years, the chairman changes, and once that happens, I mean, there is a cleanup again. What has happened? There was a huge capitalization of banks in early 2000, 2001, and essentially all that money has been squandered away. The kind of lending that they do, and nothing against any particular bank, but it does not create wealth. It is not value accretive.
So even if SBI comes to 1200, you'll not buy it?
SBI is probably the only exception I would make in PSU banks. But I'm not looking at it as a big investment bet in my portfolio.
So you own IndusInd Bank and ICICI Bank both?
Yes, I do.
And you're happy to own them?
Absolutely happy to own them.
Why have you bought into Mahindra and Mahindra Financials? Expensive, very expensive stock.
Yeah, so Mahindra Finance definitely is an expensive stock. So Mahindra and Mahindra Finance is best positioned to address the Indian rural market. They are right now present in about 2 lakh villages. There are about 6 lakh villages in India, and let's say they leave out 2 lakh. Roughly there are about 2 lakh more villages where they can increase their presence. They've been growing at 35% plus. Deteriorating fundamental for them is a growth slowdown to 25%. What kind of I mean, 25% is fantastic growth, and I'm sure once the economy revives, their growth will go back to 30-35% plus. Their systems, quality, processes are absolutely fantastic. When I'm aligning with a lender, I want to be sure that they are not going to be reckless while lending. And they seem to have their act together. They know what they're doing. So I'm very gung-ho on that. Another piece that they have is the housing finance. It is a 900,000 crore kind of a book right now. They are saying it will go to 4,000 crores in 2 years' time. At 4,000 crores, what is Gru Finance? Gru Finance is an HDFC subsidiary with a 5,500 crore book.
Trading at the price to book of 5 times.
8x, not 5x. 8x book price to book.
I'm looking forward.
So that's a huge option value being created in M&M Finance. You will not notice it right now. 3 years down the line, it will be substantial enough to notice that. Essentially, we are bullish on the rural India, and we believe M&M Finance is the best position to address that opportunity.
So just to summarize our today's interaction, as a house, your call is that big money will be made. You have to stick to right stocks, and the stocks which we've discussed, whether it's Mahindra and Mahindra Finance, Natco Pharma, Infosys, IndusInd Bank, Amara Raja, you're happy to own them irrespective of QE or GE.
Yeah, so to sum it up, yes, do not get bothered by the macros which may seem very daunting and will shake you out of your holding, but this is the time to go out there, look for good stories and invest in them.
So after this interview, if a client walks up to you and he'll tell you, Ravi, here's the check, 10 crore check, you're free to invest, but I want you to double my money in 3 years, how will you invest?
The same way that I just told you. We are going to focus on companies and stories where there is no balance sheet risk and the outlook is improving.
If you have the option to only buy one stock, and just forget about it, which is that one stock you're happy to own for next 5 years?
I think Infosys would be the one.
You expect Infosys could go to 7,000?
I don't know if it will go to 7,000. A lot of things depend on it, getting it right. But I feel the risk is far less.
The scope for Infosys to go to 7,000 is high.
Yeah, I mean, 10% correction is something I can't rule out at any point of time.
Fair point. Ravi, thank you for joining us. And before we wrap, a quick disclosure.
Yeah, it is safe to assume that us as a firm or our clients would have vested interest in the stocks that we have spoken, and it is not to be considered as an advice to buy or sell.
Appreciate your time and thank you for joining.
Thank you so much.